Going back to the thing that in spite of having so much of an education website showing the correct information, practitioners, people still make mistakes while they use super, or for that matter, in any part of the world, how best they can minimize the taxes. Every government across the globe makes its efforts to reduce the tax burden and kind of a thing. So, in your opinion, and from the people whom you have interacted, seen, what are the common mistakes people make while using the super fund?
People do make a lot of mistakes, and some mistakes are, I would say, most of them I would say are unintentional, lack of awareness, well, are time poor. So through your channel, obviously, if somebody is listening to it, the first key mistake I think is that most people don't even look at what kind of balance they have in super. They don't understand the fee structure. They don't understand where their investments are being contributed to. Is it the right kind of investment for their age group? Yes and no. And I have made those same mistakes. So I think I'm no different, but obviously I've learned over time. So people have multiple super accounts. They worked in one organization, they didn't close it, they moved to another organization, open a new super account. They keep on ignoring their investment options. They don't even know, like I was saying, if somebody is 25 years old, and if you are, let's say, your super funds is being invested in a very conservative firm, to me, that's not the best use of the money that they have in super. People overlook the insurance cover. Like I was saying, a lot of my friends, even people who are citizens of Australia, living here for 10, 15 years, they don't even have basic insurance like TPD cover or income protection insurance. I'm not saying that people need to take within super. You can take outside of super as well, but at least being aware is so important. And then sometimes people think SMSF, like I was talking about, people just feel, oh, it's self-managed super fund, so it's great. But that it's not as simple as it sounds like. And sometimes people are too conservative with their investment choices. So I would suggest like at least visit your super account every 6 months. And one good thing is that if you are dealing with a good super fund, don't stick with a bad super fund. So I have actually done one of this mistake. So I was with a really bad super fund. Didn't make much contribution to that. But recently, when I moved to a different provider, they also provide free advice, unlimited advices. So you can talk to your super fund owner. They can give you the right kind of advice. So understand what benefits they offer your super fund. Is it the right super fund? Yes or no? Where your contributions are going, where the investments are being put towards, which kind of funds it's being put towards. Don't maintain more than one super fund. It's too much of work. And also leverage the insurance needs that you may have against that super. So, like I said, don't just take super as a retirement building instrument, but take advantage of all the extra benefits that the super allows. That would be, I think, some things which I would like to point out.
So you say that super fund should not be used for retirement alone. Does it mean to say at the various life stages it has an utility? Is there a way it can be utilized in different stages of life?
Definitely. I think the way I see it is that it should be an instrument to help you build that kind of copper. So let's say somebody who is just starting out in their 20s or 30s, it's unlikely that they would reach that cap of 30,000 AUD that I was talking about. So maybe start with small voluntary contributions. People may think, oh, why should I do salary sacrifice? But in the long run, it can offer tax benefits. Any which ways you have to pay taxes, you might as well pay a lower taxes. So leverage those concessional contributions, do some small voluntary contributions, leverage the tax benefit through salary sacrifice. As people mature, let's say in their late 30s or 40s, they can definitely leverage carry forward contributions. So if I give my example, obviously my 30,000 get exhausted very quickly, but I leverage the carry forward contributions that I have from previous years. So that's one way I leverage it. In 50s or late 40s, people can try exploring SMSF options, the self-managed super fund, if it suits them. Of course, I'm not saying it's for everyone, but if it suits and if you're a good candidate for SMSF, People buy property on it, which they can sell at 60, 65. Once they have created that corpus, you sell that property, it's completely tax-free, the capital gains that you get, or even the rental income which people get. And then obviously once people turn 60, 65, they can either withdraw all that amount or they can convert it into smaller chunks of retirement income that people can get every month. So there are different ways across different life stages that people are in. It's always a good idea to sit with an accountant or a tax professional who can create that retirement plan if that's the end goal. But even if, let's say, you're not in that stage, take those small steps that one can leverage super in the best way possible.